Hello, everybody. Welcome to Friday and as always, to the Rebel Income live stream. Looking forward to our discussion today. Excited to see those of you that are here already. Hopefully, we'll get a few more coming in as we get things rolling. It's been an interesting week, as always. The market has a way of finding its own kind of turbulence sometimes, right? And not surprisingly, over the past couple of years, a lot of that volatility has come from political from the political arena, whatever side of the political fence that you stand on. Um, so that contributed to quite a lot of variability in price, and that's we'll see how that's played out for some of the positions that we've been following. But it has also produced some interesting income generating trades. So we'll get in and start taking a look at this as we get things rolling. But really quickly, just a couple of very small details. If you want to interact with me, with the group, please do take advantage of the chat area of the live stream. I'm going to be paying attention to comments in that area throughout the course of the live stream, and we'll try to fold those questions and perspectives in as we get things rolling. To the point. Thank you, Barry. Wouldn't it be nice if those moving the market didn't react to such knee-jerk actions? Well, yes, it would be. In the very, very near term, I definitely agree with that. It could be a little bit maddening if you get too focused on the day-to-day, hour-to-hour movements, some of those kinds of things. It's one of the reasons, I'll be totally honest, that I really try very hard not to pay too much attention to the market during the day, during the regular day. Today is obviously a little bit different here in this morning, as we're paying attention. We're looking at the market live while trading is happening and evaluating our positions as we go. It doesn't mean that I'm not paying attention day by day. It just means that I purposely try to limit the amount of time that I'm spending looking at the market and looking at my positions on a daily basis. We can talk a lot about what your daily routine is. I have found that my system works best when I try to limit that to no more than about a half hour a day. And the live stream is different. And when we're talking about some of the trades that we're paying attention to, obviously it's a little bit different. But in terms of just my own process, that's about what I try to limit it to. When I publish the trades, some of those kinds of things, I consider that a little bit outside that personal time. But that's generally how that works well for me. So, Barry, I guess it works well for those who make their living buying options when they're on the right side. Well, yeah, but then again, remember, when you're on the buying side of a transaction, whether you're talking about options or buying the stock, you're taking the low probability side of that transaction. So, yeah, it works out right when they're on the right side, but they're still only right about 25 to 30% of the time. I don't care how good a swing trader or momentum trader you may be, how good you are at identifying trends and things like pivot highs, pivot lows. The probabilities are not awesome. So, yeah, they do. You can be very profitable with those kinds of trades, but it takes a whole different level of attention and a whole different level of money management, and understanding that your money management strategy has to factor in the reality of not only more losing trades than winning ones, but also losing streaks. You're going to have consecutive losing trades, and you got to be able to ride through those and absorb those. It's intense when you're doing it just on a day-by-day basis. And speaking as someone who has tried to do it on a day trading basis, so many trades throughout the course of a day, it was not healthy, at least not for me. One big win can cover a multitude of sins. Well, it needs to be a really, really very large win in those cases, in my experience. So there's a reason that I've settled into what I do with Rebel Income. I find it the probabilities are nicer. It does much better on my blood pressure, and talk about the sleep test. I sleep much better at night. So, okay. With all of that said, it isn't that with Rebel Income we are dismissing trends or we're not paying attention to short-term movements. It's that we're putting them in a different context and framing them ultimately against what is out there in the market for income purposes based on fundamental strength and the valuation analysis that are kind of the core pieces of what we're using. So with that in mind, let's go ahead and take a look at some of the positions that are open right now. We're dealing with. There is one trade that is set for expiry today, and so I'm going to start with that one. That is put sale on Occidental Petroleum, and we've been in a pretty good position when we've looked at it since the trade started at the end of December. But I sold the $41 strike price for context here. This was a 3-week trade, generating about 2.6% for that 3-week period, bringing in $1.06 per share on the put sale. So that was a nice premium and a nice setup for the trade. So let's take a look and see where Occidental is sitting today. So I was selling the $41 strike. That put my assignment level down here. And the market, again, it's been started the week out kind of choppy, right in this neighborhood. But again, is some of the uncertainty around, or fear, I guess, around tariffs and whatever you think about Greenland. Some of that appears to have faded a bit. Then that's given the market some reason to rally. Occidental is up nicely up here a little bit above 44. So, and Barry, yes, I prefer slow and steady myself. Call me a turtle. I'm okay with that. I will take my time. I will get there, and it will be a lot easier for me to manage and to deal with. Okay. So Occidental is obviously in a really, really good position here. Now, let's take a look at this in terms of the opportunity to possibly manage the trade a little bit more actively than what my normal method is. As you know, I like to set my put sell and then I leave it. And as I say, the result is the result. If I get assigned, I'm actively selling a put option on stocks that I like. These are companies that I would not mind buying at the strike price that I've sold. Yeah, Barry, barring a total collapse, Oxy $42 call will be called out today, which should be a good result, right? If I recall from last time you shared your setup on Oxy, that should give you an overall nice result, even though the stock is higher than that. That's one of the things that we go into with the covered call understanding is that strike price we're selling, it puts a cap, literally a lid on how much your total gain is going to be. That's the trade-off for that immediate income. Okay, I need to expand this a little bit. Let's go to 16. There we are. And again, for context here, $1.06 was the premium I brought in on this one. 41, and the asking price is 9 cents. I'm guessing there hasn't been a lot of activity here on this one. Nice. Barry you bought it at 41.35 and brought in over 2% premium for if you were doing that for about the same duration, the same time. That's a really nice setup. That's a really nice trade, in fact. So there's plenty of open interest here. So if we wanted to buy this back, right now. And again, this is just for illustrative purposes, educational, et cetera, et cetera, et cetera, not a recommendation. If you wanted to buy this back, there's certainly enough open interest to do that, even though there hasn't been a lot of volume. So with the 9-cent asking price, remember, I brought in, I need to double check my own numbers here. Brought in $1.06. I was going to say $1.09, but $1.06 minus 9 means my net premium, if I were to buy this back, 24-day trade, yeah, so about the same. Awesome. And I will compare this result. If I were to buy this back right now, if I don't, I just let this expire, which I expect it will. It will expire worthless today, barring, as Barry was saying, a major collapse. Then I'll hang on to the entire $1.06. My 2.59% would be locked in that case. By buying this back, I'm going to give back 9 cents of that, but hang on to 97. And that's still a very, very nice result considering the $41 strike price. Is still well over 2% for 23 days. So practically the same time as you, Barry. So that's still a really, really nice result. And it opens up the opportunity to think about whether or not to continue to work with the stock, possibly roll up in time and forward in price. So with the stock 44.21, that means 44 is the at the money strike price. Here's a little over 1% that's available for next week. That's not terrible. Plenty of open interest again, and there's volume. So even though we've got a little bit of a spread between bid and ask here, got the last trade somewhere around 72 cents. So literally speaking, you could if you wanted to buy Oxy back for the 9 cents, don't even mess around with the asking price, hang on to 97, then you could turn around and sell this one for another, probably you could put in a sell to open order at 70 cents. You're only extending another week. Then you go from 97 to $1.67 brought in. Again, factoring in what you'd have to pay to buy the option back. That's at 44. So you go to 3.79% total between two trades that basically extend out a month in time. That's not too bad. A little under 4% for 1 month. That annualizes pretty nicely. Even if I just simply bought the option back, didn't roll it, it's still 2.3% for my 23-day trade. And that works out to an average of about 15 trades per year. So 2.36, we're still in the neighborhood of 35%, which is very, very nice. Now let's contrast these are just put sales with Barry's awesome covered call trade. So he brought in 91 cents. And when you consider the difference between the $42 strike price he sold with the $41.35 price he paid, 65 cents plus 91 cents, $1.56. You divide that by 41, that's 3.8% for 24 days. I really like that trade. That's really, really nice. So, Barry, getting an early start on your tallies. Appreciate that. Those. Thank you for sharing those numbers. That's really, really useful. So, okay. So that's Occidental. That's obviously things are looking pretty favorable on this. You know, even if you didn't love the idea of the 7-day trade, here's 44. for 2 weeks, a little under 2%. Also not terrible. So, okay, Nike, $63 put, looks like it will expire worthless as well today also. And that's another one that obviously we're working with here that's set for next week. So you went 1 week earlier on yours, and selling a little bit lower strike price than I did. So you went a little bit more conservative in terms of strike price, and I would even argue possibly a little bit more conservative in terms of time. I sold more time, so brought in $1.20 at 63. Man, that's almost 2% for what, 2 weeks? 1 week, excuse me. Yeah, I brought in a little under 2% for a 2-week trade on this one, selling the $64 strike price. Felt pretty good about it, but Barry, you beat me. You beat me in time, you beat me in premium and in yield. So there you go. Nice. I like it. It's nice it's nice not only when I see people doing better than me. What I really like seeing, competition aside, made the trade on the 6th. Okay, so it was about 2 weeks for you. That's fine, no problem. You still did better than me. What I like seeing is not just competition aside. What I like seeing from people is when these concepts start to make sense to you, you start to you're not only placing put selling trades, but you're starting to apply the method in your own way. It may not exactly line up with everything that I talk about doing or that I prefer doing. I'm speaking strictly in terms of how Rebel Income works for me, how I've built it around my own preferences. But the hope is that by doing that, by sharing that information, I help you to do the same. And so that's awesome. You think you went rogue on it? Well, in retrospect, did you really? I mean, again, we've seen a nice little bounce here, and up at 65. So that's really effective timing, is what I would say that is. When all is said and done, sometimes even if we're not really exactly trying to play the timing game, the truth is sometimes the just looking for the right setup in the right moment. And for me, the right setup means income. It means the right price in terms of what I may be willing to pay. When all of those elements are lining up nicely, the truth is sometimes you end up timing it better than the most. So call it going rogue if you want. I'm just going to call it a good trade. All right. Honestly, really hoping to get assigned at 63. Okay, fair enough. And there's still another week here for me, and we're just a little bit below 65 and maybe pulling back a little bit here right now. So there's still room where I could be assigned. Again, that's when I said that you were probably a little bit more conservative by selling a little bit closer expiration than I am. You placed it earlier, so it's about the same time period. But that's part of the impact, right? I've got another week on this where it could still drop below my $64 strike. 63 is all the way down here. Not only, excuse me, did you benefit from your earlier timing, Barry, but you also set the strike price for your trade right down here at where it looks like really solid support should be sitting, based on these pivot lows from just earlier this week. And there's a lot of chop here at the beginning of January, and then again we have a really strong pivot low here in December. So this looks like a really, really nice really nice level of support that you know, was a good reference point to use for that put sell. I like to use where I think current support is as a starting point, and then remembering that it's an area, not an exact price. I may end up at 64. If I can, I may even go down to 62. Sometimes I get to go down a little bit below support, and that's kind of nice too. It just makes the trade a little bit more conservative. Either way, Barry, you did awesome, and I like that you're done with this one where I get to wait for another week. That's cool. I like that you placed the trade a week before my own trade came out. So yeah, previously had a $57 put sell, then bought it back. Gotcha. So all the way back here, probably from this from this low here, bought it back and rolled up. All of this, you know, this is where this kind of activity, even though the overall longer trend continues to be down, notice how the 200-day moving average here has started to flatten. It's beginning to bend up, but I'm still going to call it mostly flattened. And when you start to see, this is one of the things that is interesting about paying attention to trends, you know, is when you see long-term trends kind of start to flatten, what you start to see is a lot of what I'd like to call consolidation. So I'm going to redraw this support at 63. You start to see a lot of variability between highs and lows that, you know, this kind of drop, this is kind of an outlier. This kind of a peak, this is a little bit of an outlier. But what you're starting to see is a little bit of a consolidation level at the lower end of the trend, and that flattening of the 200-day average, 200-day moving average uh, is an indication that that consolidation may continue for a little bit. And as you're saying, Barry, this is when the stock's volatility becomes really beneficial. You see these outliers like this and this here, even down here. Uh, these are moves that increase the stock's general volatility. That affects implied volatility in a positive way, and within the consolidation range, it leads to some really nice income generating trades. The longer the consolidation period holds, generally speaking, the more opportunities there are to keep placing good trades. So yeah, and I do agree. I do agree with that. Nike is still very undervalued. That's true both from the perspective of the long-term trend. I mean, good heavens, all the way back here in 2022 was up around $170. Looked like unbeatable world beater, and you know, now we're all the way down here in the 60s. I'm okay with that. I like it at these depressed prices. The way that the 20-day moving average, talking about technicals again a little bit, we're seeing a little bit of a pennant starting to form between the 20-day moving average and the 200-day moving average. That also is an indication that not only of consolidation, but we could be seeing some building momentum towards another bullish breakout. This one wasn't strong enough to sustain itself, was not able to reverse the downward trend. But we may be looking at another push, another rally, whether or not that ultimately reverses the almost 4-year downward trend now. Obviously, that remains to be seen. But technically speaking, this is starting to look like it's building. I think we're seeing some bullish momentum building towards a more sustained rally. If we're talking frankly about Nike, and that's not just based on what I think of the stock or what I hope happens. It looks like it looks like what we're seeing is building towards that as well. Think of a coil tightening, right? This is what I like to talk about. This is kind of the analogy I like to use when we're talking about consolidation and stabilization periods. A lot of traders tend to think of consolidation, stabilization as times when trends moderate, they become a little bit more gradual, maybe a little bit less interesting. I think they become more interesting because excuse me, when you look at most upward trends, if the slope is very exaggerated, a trend like this that we saw June and July is very hard to maintain because the slope is so exaggerated. And the proof, this Nike provides an interesting proof of that, where it peaks here and then it fails. It extends the long-term downward trend even further. So this, as impressive as this rally was, this was ultimately unsustainable. The slope was just way too sharp. So these consolidation periods are productive. They tend to moderate the slope of upward trends and ultimately to make them more sustainable. And that's why it's one of the interesting side notes. It comes from, technically speaking, when I'm talking about my charts, if I start here at this low back in April of last year, and then I draw and this is a bad, ugly line, I know. But if I connect that, to this low, try this low here, and here, I'm not worrying so much about this one since this is an outlier. Here we have still a pattern of higher lows, higher highs. What we're starting to see here is an intermediate trend. This aside, you're starting to look at an interesting gradual upward slope. So we'll see whether or not it's sustainable is an open question. The way that the distance between the 20-day and the 200-day average, however, is starting to narrow. We're starting to see this pennant tighten up. That's interesting. Very much like a tightening coil. And when that coil, the more it tightens, the more energy you're storing inside of it. At some point, it's got to release and expend that energy. And when it does, the spring back is usually accelerated. So, okay. All right. Well, Barry got me to jump ahead to Nike, which was awesome. We already did Oxy. Jay, welcome. Glad you're here. All right. Let's go ahead and take a look now at BMY. This is another one. I placed this one a week before the Nike trade, selling the $55 strike price. It also expires next week. And this is a more conservative trade, brought in 1.51% for my 3-week trade. And I like that. That's still well within the 1.5% per month that I'm trying to average. And so we'll see where this one's at. But that was more than acceptable, more than enough for what I wanted. All right. So again, sold the $55 strike, 83 cents. And this one, we actually saw it peaked right up here about 57 last week, and then we saw it fall back in the early part of the week. And it's rallying now, and it's just a little bit above 55. Now that looks nice considering that there's still a week to go, but this has a completely different profile than Nike, doesn't it? And part of the difference comes in really, look at the distance between the 200-day moving average which is up here right around 55. And the 200-day moving average, which is right at 48. So we've got a $7 difference between these two major moving averages. And again, remember what I was just talking about in terms of the sustainability of trends. You know, from this low here in November down around 42, you know, it's interesting to see Bristol Myers rebound the way that it has. And the value proposition is still really nice here. Even at 55, it's, you know, my fair value target is well above that mark. So this is still a good, an interesting income generating trade, but there's also a lot more potential for variability simply because of the accelerated pace of this upward trend and the distance that has created, not only from these moving averages, but the stock's current price and all the way down here at the 200-day moving average. It's not a given that it's going to fill that gap, but to some extent, it's starting to look a little bit like what was happening here at the end of 2024. Notice it didn't fill that right away. It waited until April to do that. But this distance does open up the possibility for all of that space to get filled in. So Barry was assigned last week at 56, so you went with a higher strike price, shorter time period. So now you're waiting on a call opportunity, and it kind of sort of gave you one at the end of last week, but dropped quickly off below that. And let's go ahead and take a look at the option chain on this one. Again, I brought in on this one 80 cents in the terms of premium brought in. So Bristol Myers BMY. Just barely above 55 now. So if I wanted to buy this back, 94 cents on the ask, I'd have to give back some of the, not only all of the premium, but I'd have to pay a little bit more out as well. There's enough open interest here, not a ton of activity. There's enough to be to provide liquidity, but a little bit of an exaggeration between bid and ask price here I don't love. Considering, looks like the trading range for the day so far is between 60 and 69. I think this asking price has got to come down. You could, if you're working with Bristol Myers, this asking price should certainly be lower. But that doesn't really offer a great opportunity to think about rolling, anything along those lines. But in terms of what Barry's looking at, here's some covered calls. So 56 is where you came in on it. You brought in 80 cents, so it was a little bit lower than 1.5% for 11 days. But again, a little under 1.5% for the 11 days. You're still doing really nicely on an annualized basis, right? So you're over 3% for a 1 month setup in that case. So here's 85 at the 56. Again, the difference between bid and asking prices is a little bit exaggerated here. So that begs questions. Yep. Kind of low open interest, no volume here. So no trades taken so far here on these ones. You're going to see about the same for this one as well. Okay. Good open interest. There's enough open interest here to provide liquidity, even though there hasn't been any volume here. So that's interesting. $28 days. This goes out to February week 3. Now we'll likely see a little bit of a change here in activity. Yeah, this is where the volume is, and sometimes what you see here, even with stocks that offer weekly options, you'll see open interest, but not a ton of volume. You won't see a lot of activity on the weeklies. However, the monthlies, which are the ones that are set at the standard third Friday expiration, tend to see the most actual volume, and that's kind of typical of Bristol Myers right now, anyway. So that's interesting. Here's $1.01, so a little under 2% for 4 weeks. Here you can get about 1.5% for 4 weeks at 57. So that's also interesting. That's not, again, not a recommendation, but also not terrible. Lots of open interest here on this one. Previous close was yesterday, 93 cents. I mean, take it or leave it, but selling to open, covered call at 57 here, possibly. Again, not a recommendation. You don't have to do it. But if you took this as a reference point, there's a covered call for 4 weeks that offers the potential for a $1 gain. If you can get that 93 cents, you kind of would have to wait for the market to come to you, right? But you were assigned at 56, so that's 1.66% for 4 weeks. Again, not terrible, and that's, again, if you get called out of that, then there's another $1 in premiums. So you go to $1.93, divide by your 56, now 3.44%. In terms of total return, that covered call is not terrible. Take it or don't. It's totally that's an individualized decision we would all have to make, but that's interesting. Okay. So that's Bristol Myers. We already talked about Nike. Let's talk about the put sale that we placed this week, tapping back into. May place good to cancel for $1. Yeah. Set the price. If the market comes to you, awesome, right? There's plenty of open interest. So we're dipping back into food stocks a little bit with this week's put sale with CPB, and I have some other positions in the same industry, so it's getting a little bit loaded in terms of overall portfolio. This is an area of the market that has just really been deeply ignored and deeply discounted. From this high up around 52 in September of 2024, all the way down here at 26. These are historical lows. Yeah. Conagra is another one. These are historical lows for these guys. Forget the pandemic, This is just not a stock that is normal to see trading down in these low ranges, not since, good heavens, not since 2010. So these are deep, deep discounts. And yeah, you can argue the overall trends for a lot of these consumer staple stocks. CPB Campbell's, for example, one of the arguments against a lot of bullish activity for this stock is with inflation high. Let's face it, household budgets tightening. Um, there is a push towards value brands, and that's actually one of the reasons I like Campbell's. Um, but what you see is a contraction of uh, of margins right now um, for a lot of food companies, just because of tariffs, because of high inflation, and even though rates have been coming down, let's face it, the interest rates are still higher than they have been, or by a lot of people's measurements, by where maybe they should be. I don't know about that. I do know they're still elevated compared to historical levels over the last 10 years or so. I think we've gotten extremely used to a very, very low interest rate environment, and that's one of the things that is pushing on enthusiasm sentiment for these stocks. The irony about that is that these are companies, Conagra, like Barry was saying, Campbell's, even Kraft Heinz. These are companies that know how to manage through those variations. You can say what you want about Berkshire Hathaway selling out of their holdings on Kraft Heinz, and that's certainly one of the things. One of the additional side notes that's adding some bearish momentum right now. But the fact is that demand for these things doesn't go away, even as household budgets tighten. The push towards more value brands actually benefits companies like Campbell's, from Kraft Heinz, some of these kinds of things, because some of these recognizable names are where there is a lot of value, um, at least in my experience. So I think that overall, the longer trend should ultimately come back on these, and the valuations are just simply so depressed that they're really starting to become very, very hard to ignore. One of the things that is not changing for a company like Campbell's is their focus on shareholder returns. They haven't been cutting dividends, they've been maintaining them, they've been reaffirming them in many cases, in fact. And so you're seeing yields here that, we're up here in the range of long-term bond yields now with the stock at these prices. So Campbell's is a really interesting example of what I would call an equity bond. The bond element coming from the dividend yield, and the equity side, the fact that this is a publicly traded stock, offering the opportunity. If I end up getting assigned down here on Campbell Soup, and I sold, the $26 strike price, we're still right in that range right now, and I've got a full month on this. Part of the reason that I was willing to do this is not just because this is where the premium was. This one is kind of like Bristol Myers, where some of the weeklies were not really offering very productive trades. Here's at the money for 26.50, 14 days. Again, when you see the spread here between bid and ask, these become really, really hard to work with. So it was really a matter, had to really come out to about the 4-week mark in order to find a useful level to work with here. But even at 26, this is a really, really nice, this is a really nice price. So part of the reason I was willing to go out a full month on this was because this does increase the likelihood I could get assigned at 26. But if I do, even if it doesn't immediately pick up momentum, I get to sit and pick up an almost 6% yield just by collecting dividends. Now it's just recently gone ex-dividend, so you'd have to own the stock right now already. You would have had to buy that before the 8th of January. So that one I'm not going to get. Even if I get assigned at the beginning of February, which the payout date for this is February 2nd. I'm not going to get that dividend, but that's okay. If I end up holding the stock for a few months, then this is a useful dividend. The last payment was 39 cents. If it's about the same amount the next time, that's a little over 1% for relative to the price I get assigned at it, assuming I do get assigned at 26. If this range, this low level, we're starting to see some stabilization here. So if we call this, major support here, and I try to extrapolate a little bit and say, well, if it's going to begin to consolidate, where is the top end of that range likely to be? We've got immediate resistance from the 20-day moving average, so it'd have to push above that a bit. It may come, it could be somewhere in the $28 range if I just work off of these pivot lows from December. It could be a little bit above that. It could be closer to 30 if I base it on these pivots that we saw in October and November. I'm betting more on about 28 just because of the way that the stock's movement has been, and its variations aren't as wide. Could even be a little bit more narrow than that. Right now, top end resistance is we're talking about maybe a $1 difference. This is about 3 weeks of time, this entire range here, and it's trading in a very tight range, less than $1 between the top and the bottom. So if this consolidation range continues out, then what we'll see is a continuation of these of ranges like this. Difference between bid and ask prices that at the money that continue to be a little bit exaggerated. Low implied volatility for stocks like Campbell's. They're good if you own the stock because you just don't get a lot of movement, and then you just get to sit and take in the dividends. They kind of wreak havoc a little bit on the option side. You don't get exaggerated or inflated premiums in these cases. So if you're going to work with these stocks, you kind of have to be willing to just look for good enough and be happy with that. And that's really where my put sell for this week kind of fell in, even though it was about 3%. That was also let's see, expires 2/20. Yeah. A little bit unique at the time. So, all right. So that's Campbell's. The last trade is that I have on deck is one that I placed yesterday. I didn't send out an alert for it, but Intel is a stock I've held for quite a while. I was assigned back in 2022 on this one at 55.50. Watched it drop way down below as momentum has been really, really bearish. And momentum lately picked it up, and it didn't actually hit 56. It's topped out at about 54. A little bit above that, and it's coming back very sharply again today. But this big movement here was an opportunity to bring in 2.5% for a 2-day trade. So I did it. This will expire worthless, but that also means that I've not only paid myself a nice little dividend for 2 days, but this $1.40 can be counted even further against my my cost basis in Intel. And if this pullback, again, talking about moderation of trends, this pullback gives gives this trend a way to moderate itself a little bit and possibly recenter somewhere along this line. That's okay. That'll help Intel's overall momentum that we've been seeing since August sustain itself a little bit longer. This is a really good example of the unsustainability of very steep slopes. At some point, this becomes almost inevitable. So, all right. Those are all the trades that I have on deck. We've got some time, so I'm going to go ahead and open this up to the group. And any stocks that you would like to review and take a look at, we can certainly do that. Devin, nice. Okay, Barry, thank you. Sold a $40 call on Devon Energy. This one is showing some momentum. So expires February 6th, so the first week of February. So you're about 2 weeks out on this one. So here's, sorry, let me change my colors. Make this look a little bit more optimistic. So 40, seeing some nice momentum here, and an interesting little gap today. See if that's sustainable, but it looks like it could be breaking above top line resistance right now. If 38 becomes new support, then that $40 could be completely within range. We're also starting to see where the sideways trend for Devon is bending upwards, which could also be a net positive. So that's not just on the basis of this momentum. This is going all the way back to April of last year. This is an intermediate term trend for now that is looking very much like it could convert into a long-term upward trend. I'm in at Devon again at a little bit higher price than where you're at, Barry, but this is nice. And with his cost basis down around just a little bit above 37, that's a nice trade for sure. We're looking at a potential trend reversal here of Devon's long-term trend. This could be a really nice setup. And for the next 2 weeks, I think you're in a good spot. So start in 2024 around 55. And he's worked it with covered calls and some other income generating trades. So, yep. And I'm in around 55, and I'm still in at around 55. I've been enjoying the dividends, and I'm fine with that. but I've not been using the things like cover calls in a downward trend the same way. So I get to wait a little bit longer. I'm okay with that. But because Barry likes these, there you go. I like it. Nice setup on Devon. Nice trade and position management to bring yourself into a position where uh, now that the momentum is starting to shift in a very clearly more bullish direction, uh, you're in a position to take advantage also faster than I am. So, yep, reinvesting the dividends to bring cost basis lower. Absolutely. And that's a great strategy. That's a great strategy. A lot of people, um, if you're familiar with drip investing, it's dividend reinvestment. A lot of companies will offer a drip program where you can buy the stock from the company, and when they pay a dividend, it automatically purchases new shares. That also helps to bring your cost basis down. So very smart. All right. Well, those are the trades for now. That's what's happening this week, and where we're sitting at the current time. I hope this has been useful. I appreciate certainly those of you who've been here and for your participation. Barry, thanks for sharing so actively with the group things that you've been doing. As always, I hope that everybody has a wonderful weekend and a good week coming up. If you have anything that comes up, any questions or concerns, you also do that on your EFTs and closed-end funds. That's awesome. That's awesome. If there's anything that comes up between now and next week, please don't hesitate to let me know. Rebelincomesystem@gmail.com is my email address. I do respond to emails. I try to do that as soon as I can. If you want to reach out on Substack or on Discord as well, I pay attention to those messages. I respond to them as soon as I'm able to get them. So please do reach out. Otherwise, we will talk again next Friday. Thank you, everybody. Have a great one.